We are talking about investing in challenging times. Those of you who are already investors or clients of Simplus, let me congratulate you because you have overcome the first challenge, that is of finding a good investment advisor. There are a lot of people calling themselves advisors who are more of salespeople. The real advisors may not really need to go looking for clients. It's generally the other way around. The clients will go looking for them. That is why I congratulate you that if you are with Simplus, you are in good hands. What I intend to do this morning in 2 sessions with a small break in between is draw your attention to a few very important and often overlooked aspects of personal investment. Deepak made a pertinent point in his introduction that very often it is not investment that challenges us, it's not the times that challenge us. The problem very often lies with us. So let me start with a saying by Jason Zweig, who's one of the world's finest contemporary financial writers. He says so much is written about risk. But do you know what risk is? Or do you want to see what risk is? If you want to see what risk is, step up to the nearest mirror. That is risk. It's not the stock market, it's not the real estate market, it's not the commodities markets that carry risk. It is our behavior there. What we do when confronted with differing investment situations that can increase, decrease, create, or manage risk. With these few words, let's tackle something that people always talk about. Times are changing. These are turbulent times. A lot of turmoil, stress. We find it difficult to exercise control. While we may be living in turbulent times, let me make it very clear that we are not the only people who have lived in turbulent times. A lot of people in different generations, in different eras, have lived in turbulent times. We would find it difficult to pick one person in this room who has lived through, say, World War II. If you think these days are difficult, the period from 1939 to 1945 was much more difficult. So there have been bad situations, bad times in other eras also. There are a lot of things over which we have no control, and that is the first thing that we have to accept and realize. We cannot prevent Russia from interfering in Ukraine. We cannot bring peace between India and Pakistan or solve the Kashmir problem. We have no control over whether the Israelis and Palestinians will stop fighting. So we have to realize that there are very few things that we can control. And we have to focus on these few aspects, especially of our financial life, where we may be able to control. And the first realization in personal investment is that due to advancing technology, life itself is speeding up. I open with a saying by Sir John Templeton, one of the giants in the investment industry of the last century. He died a few years back. He says this: asset price fluctuations may be even greater and more frequent in future because all human activity is speeding up. So if you think that we are not going to have booms and recessions, price bubbles, crashes in the stock market, if you think the regulators like the Securities Exchange Commission of the United States or the Financial Services Regulatory Authority FSA of the UK or India's SEBI can eliminate all these, we are sadly mistaken. These fluctuations, volatility, booms and recessions are part and parcel of markets, especially the stock markets. And John Templeton is saying that they can even be more frequent as we go along. This is something that we have to realize. The next question that we have to ask ourselves is, are we absolutely and completely helpless in the face of this multitude of things that we cannot control? All that depends on us. It depends on the kind of decisions we take, the choices we make. If we take bad decisions, the outcomes will also be bad. Our stress levels will increase. Carl Richards, who specializes in depicting financial concepts and financial ideas with very simple graphs like this. The worse your decision, the greater your stress level. So, my whole objective this morning is to try to present before you a few decisions, a few paths which you can take that will make your personal investing a little more effective, that will reduce your stress levels. Jack Welch, a former chairman of General Electric, said this: control your destiny or someone else will. And that is increasingly true today. When we have a gigantic marketing machine for all products, including financial services. A lot of them make unrealistic projections, unrealistic claims, and people fall for them. George Soros, one of the world's biggest speculators and traders, he says, if your investments are exciting, if you're having fun, there is something wrong with your investments. Good investment is boring. If when you are with your financial advisor, the financial advisor appears to be talking common sense, but there is no excitement. What he is talking to you is not something you're going to be able to reproduce when having cocktails and dinner and tell interesting stories to your friends. If you have such an investment advisor who makes the whole investment process very regular, automated, smooth, steady, something that really does not require you to get obsessed about investment, you are probably in the hands of a very good advisor. Good investment is boring. Understand this. Deepak also made a brief mention about a concept called financial freedom. Have we ever reflected about what financial freedom is? I think we may have. Because everybody's objective, mine included, is to reach a stage one day when I have enough money. Enough for what? This is what we have to examine. And I want to take you one step further because this is very important. I want you to ask yourself a question, whether we can calculate what financial freedom is. Now, don't get scared by this term calculation. You don't require any advanced mathematics, probably third standard level of mathematics. Let's examine financial freedom first. Financial freedom is when you work because you want to, not because you have to. I know several people who work into their 80s, who work into their 90s. A leading criminal lawyer in this city died recently in his 90s. A week before he died, he was still fighting cases in the court. He had made a lot of money in his probably 6 or 7 decades of practice. He did not need to work. He wanted to work because he didn't want to sit idle. And probably that was one of the factors involved in his long and very productive life. So financial freedom is something that is good to aim for. All of us aspire to do it. My question is, can we calculate how much we need? I want to give this to you because if you can understand this from today's talk, you will understand a lot, and you can make these calculations as you go through life, so you know what to aim for at some point of time. Another way of asking the question is, can I retire? I get these calls. I'm in Kuwait. I've worked here for 30 years. I started at 25. I am now 55. I can work for another 5 years. But I would like to come back to India. Can I come back? What is the person asking? Have I achieved financial freedom? Can I retire? This is the question that is being asked. Fortunately for us, using a little common sense, and like I said, third standard level mathematics, it is possible to actually calculate whether we have achieved financial freedom. The starting point in this calculation is, when I retire, what is my monthly expenditure? Your financial advisors will of course help you to project if you're retiring 20 or 30 years from now, based on historical inflation. They may project some figure. To make matters simple for this morning's discussions, or reflections I would say, I will take the case of somebody who is retiring today and somebody who's in retirement. Monthly normal living expenses are going to be something like 50,000 rupees per month. I've got three scenarios here. My three scenarios are an unsatisfactory position on retirement, a satisfactory position on retirement, and a good position on retirement. Unsatisfactory, satisfactory, good. And to help us arrive at this conclusion, we have certain deciding factors. So I'm retiring today. I ask myself a question: do I have health insurance? We are now concentrating only on the unsatisfactory part, and I find I have no health insurance. Do I have an emergency fund? An emergency fund is a very important concept in financial planning. Everyone must set aside a certain sum of money to meet emergencies. Different authors have different estimates, which means there is no correct estimate of an emergency fund. I come from a very conservative school of investment advisors. So I will say, in the Indian context, that every family needs an emergency fund equal to 1 year's normal living expenses, 12 months normal living expenses. So in our case, if you have 50,000 rupees as the monthly normal living expenses, we are talking about 6 lakh rupees. Do I have an emergency fund? No. Do I have a residence, a house, an apartment, any residence, which I own? The answer is yes. Do I have any outstanding loans? I'm retiring today. Do I still have to repay loans? Answer is no. Are my children independent? Yes. Do I have money which, if I invest, interest on that money in something safe like a bank deposit will give me something like 50,000 rupees a month? And when I look at my resources, let's assume for a moment that all my money is in a most popular and common form of investment, the bank deposit. I see that I have 90 lakh rupees in bank deposits. Now I have taken not today's interest rates of 8.5 or 8.75% or even 9%. We have also seen interest rates of 5 or 5.25% here about 6 or 7 years back. So I have taken a midpoint of about 7.5%, because interest rates can move down. So when I take my interest rate of 7.5% and I invest 90 lakhs, I get something like 6.75 lakhs of interest. 60 or 70,000 rupees is the tax I'm going to pay, assuming that I'm not making any tax saving investments. And when I deduct my 60 or 70,000 rupees from my 6.75 that I earned, I get about 6 lakhs, which will carry me through comfortably for meeting my normal expenses. I do not have any other money. I call it a growth corpus. Let's keep it for the time being. And my total resources now are 90 lakh rupees. Quickly, let us look at this. What do I have? Let's not focus on what I don't have. What do I have? I have a house or an apartment. Obviously, I don't have loans, so it is fully paid for. I have no dependents except a spouse, perhaps, husband or wife. I have 90 lakh rupees. My expenses are 50,000. A lot of people say that this is a very good scenario in retirement. And believe me, you will have no problem for perhaps 2-3 years, until your 50,000 normal expenses slowly rise to 55, 60, 65,000. Then what's going to happen? What happens 5, 6, 7, 10 years down the line when the expenses are now 70, 75, 80,000 rupees? What happens is, you will start spending your capital. What happens when your capital is over? That may last you 10, 11 years. You're going to sell your house. This is what has happened to a number of people whom we have advised over the last 3 decades. Understand one thing, the best doctor in the world cannot cure a terminally ill patient who has got about a month to live. The best financial advisor in the world cannot help you if you have nothing. If you have no assets, if you have no sources of income, if you have no fund flows, fund inflows. So this is something where you set out on the path of slow destruction, financial destruction. A lot of people like this ultimately move to charitable homes, old age homes, assisted living centers. They sell off their apartment or house, use that corpus to invest and then pay the living fees, because everything is taken care of at a very low cost. Let's move to a satisfactory position. I have some health insurance and I have my emergency fund. If I need to spend 50,000 rupees, I've got 6 lakhs. I own my residence. I have no loans to be repaid. My children are independent. I have a regular returns corpus of 90 lakh rupees. Let's say in bank deposits, I'm getting my 6.75. I'm paying my taxes of 60 or 70,000 rupees on this, and I have my 50,000 rupees coming in after tax. But I have another 90 lakh rupees kept in either real estate, mutual funds, stocks, something that will grow over time. Now my total resources are 6 lakhs in the emergency fund, 90 lakh rupees in the regular returns corpus, 90 lakh rupees in the growth corpus, 186 lakhs totally. The situation is a little different. After 3 years, 4 years, 5 years, my 50,000 expenses rise to 60, 65, 70. What do I now do? I look at my growth corpus. If the stock market is very high, virtually at its peak, we are 1%, 1.5% away from the all-time high in the stock market. In fact, we have been almost living on a day-to-day high. I would liquidate something from the growth corpus, add it to the regular returns corpus. I may even make withdrawals directly from the growth corpus, because sometimes that is better. Keeping on adding to your regular returns corpus can push you into a higher tax bracket sometimes. That's not a very happy thing to happen. What if, when I look to my growth corpus, my regular returns corpus being inadequate, I find that the index is not 30,000, the index is 12,000. There's been a huge fall, huge fall. I don't have to worry. Why? I can now boldly start spending from here, from my regular returns corpus. Spend the capital. You start spending the capital, it's going to take you 10 or 11 years to work your way through that capital. In 10 or 11 years, you can be very confident that your growth corpus, there will be a time once again when it comes back. That's when you can equalize the two. Let's move to something that's good. And you'll find when you go to good, there is no difference between the satisfactory position and the good position, except for the growth corpus being twice the regular returns corpus. These are your total assets. There's a very important ratio here. That's why you find these two figures in bold, 90 and 180. 1:2. Somebody who can maintain a 1:2 ratio between a regular returns corpus and a growth corpus. The probability that you will run out of money is vastly reduced. Nothing can be eliminated, let me tell you. Any amount of money may not be enough, but the probability that you will not only not run out of money, the probability that your wealth will slowly and steadily increase as you go through time is good in this case. Most people who have achieved this not only do not run out of money, as time passes by, the ratio slowly increases. It does not remain at 1:2. It slowly goes to 1:2.2, 1:2.3. Recently, a client of mine who had retired and who does these calculations on a regular basis, every quarter or every half year, it started out with about 1:2.05 or 1:2.06. The other day it crosses 1:3. What does it mean? 1:3 means in this period of 6 or 7 or 8 years, not only has his total financial resource taken care of his needs. We all know in the last 6 or 7 years, at least 4 or 5 years, inflation has been very, very high, averaging 10%, 11% on the consumer price index side. In this period, starting out with a 1:2 ratio between regular returns and growth, this person has actually increased his wealth. Now, people who achieve this kind of a thing are generally able to leave legacy values. That is, they are able to leave money after their lifetime to the people who come after them or to charity or whatever it is. This is what we should aim for. And this is what financial advisors like Simplus, who keep the interest of a client paramount, help you to aim for. So when they do their calculations, when they are telling you keep so much in an emergency fund, keep something else for retirement, build corpuses, understand that they are basing their advice on some very sound principles and some very sound calculations. This is a real asset that you can have. And these are the kind of points in the time we have, I want to make this morning. So when we use the word financial freedom, let us not use it lightly. Let us use it regardless of where we are. We may be 40, we may be 30, we may be 60. But let us ask ourselves the question, what are my normal monthly living expenses? Based on that, can I work back something? What are the resources I must have if I were retiring today? If you have achieved this at the age of 45, wonderful. You have achieved financial freedom. Does not mean you have to stop working from tomorrow. That is a choice that you can make. There are people who have quit working, gone into various social service, doing work, productive work, excellent work, but not for money. This is a very important starting point, and most of what I have to say after this will be focused on financial freedom. Let me make my third point for the morning. How do we embark upon the journey to financial freedom? And the first concept is, we must be financially responsible. Financial literacy has no meaning. You can be financially literate. It may not help you. You may be holding a doctorate in finance, I've seen such people making terrible mistakes in their own personal investments. What is financial responsibility? The best answer comes from a little known author called Frank Nettie. Not many people have heard of him. But Frank Nettie has written a very good book on retirement planning. And in the course of that book, he says, by law you have the right, by nature you have a duty, and to your family you have an obligation to be a good steward of all your assets. A long sentence, but let us analyze it a little bit, because this one long sentence throws up four marvelous ideas, four ideas. What are those ideas? Let's count them. You have a certain legal right. Your human nature casts upon you a duty. And to your family you have a responsibility and obligation to be a good steward of all your assets. Let's examine these four ideas, not from top to bottom, but from bottom to top. The point he's making is that you must be a good steward, a guardian, an administrator of your assets. Why? Once again, working from the bottom. Because you have an obligation to your family. I see so many people taking risks, sometimes into their 50s, sometimes when the children have not completed education, doing foolish things. It affects the family. Sometimes it affects the family psychologically. Bad decisions have caused psychological depression in a few cases. So it can affect the family not just financially. It can affect in various kinds of other ways, some of which cannot be managed. For some there may not be a cure. Another point is, we are human beings. We are supposed to be, I deliberately use the word supposed to be, at the height of creation or evolution, whatever you want to believe in. And if you are at that height, we have got a tremendous capacity for good, maybe an even greater capacity for bad, if you see the kind of environmental degradation, etc. So just as you're supposed to conserve the environment, make the world a better place to live in, leave the world a little better than when we came into it. Same thing we are supposed to do with our financial assets also. And this guardianship of our assets, the obligation we have to our family, the duty that we have as human beings, is recognized legally by most countries which have market economies. That is why when the lawmakers sit to draft the laws, you will always find incentives given for savings and investment. Section 80C in the Indian context. United States, you have the IRA, the individual revenue account, a retirement account, the 401k pension plans. In India, we have an instrument like the Public Provident Fund, the PPF, where you get a certain benefit when you invest. All interest is tax-free, all withdrawals are tax-free. This is because governments recognize this by law. They recognize by law that you have a nature as a human being, you have an obligation to your family to be a good guardian of your assets. And if we want to be financially responsible, then the first thing that we have to do is, we have to understand the difference between investment and speculation. We have to also understand that the two are totally different things. We have to understand that speculation is not just a thoroughly useless activity. It can be a very harmful activity. How do we understand the difference between investment and speculation? The best distinction that I have come across between the two concepts is that investment is the purchase of an asset for the conservation of wealth and the increase of wealth, with the emphasis on the conservation of wealth. Wildlife conservation. Conservation is protection, safeguard. I want to invest. I want my principal to be safe. I want to earn something on it. Doesn't matter if my earnings are not very high, if they are reasonable. Safety first. That is investment. Speculation is the purchase of an asset for the conservation of wealth and the increase of wealth, with the emphasis on the increase of wealth. If you look at this one slide, you understand why it is easy to get distracted from the path of investment. How easy it is for the marketing machinery of the financial services industry to confuse speculation and investment. The wordings are absolutely the same, the top and the bottom. It's just a shift of emphasis. The investor wants to invest ₹1,00,000. I do not want my 1 lakh to become 99,999. I don't mind if I get only 8% per annum. The speculator wants my 1 lakh to become 2 lakhs, fast. In the process, the speculator knows that my 1 lakh can drop to 90, 80, 50,000. Or if you do things like derivatives trading, I can lose my entire 1 lakh. I can still be owing the broker. I can lose more than what I have. It is very, very important to understand the difference between investment and speculation. It's also important to understand that the two are very closely related. Investment is safe speculation. Speculation is hazardous, dangerous investment. And if you want to understand the real foolishness of speculation, we can do so by a very simple example. I'm giving you an example of an investment. We'll call it investment just for the next 2 minutes, which gives you 24% return per annum. You know, in these days of 9% bank deposits, 24% is phenomenally attractive. Just for the next 1 minute, we'll assume that this is safe. Beyond that, it is not safe. The deal is very simple. You give your friend 100 rupees on the 1st of January. Your friend will return to you 124 rupees on the 31st of December, 12 months later. Simple 1 year cumulative deposit, but 24%. 24 rupees is your income in 12 months. We'll not do the detailed mathematical calculations. 24 rupees divided by 12 months, 2 rupees per month. How does your money grow? At the end of the first month, 100 becomes 102. Second month, 102 becomes 104. Third month, it becomes 106, etc. Let me draw your attention to the fact that even at this phenomenally high rate of 24% per annum, it takes 3 months for 100 to become 106. Compare this to what stock market speculators want. At 9:30 when the market opens, when they are having breakfast, they want to buy a stock at 100. And they'll be very disappointed if they cannot sell it at 106 when they are having lunch 3 hours later. 100 to 106 at 24% rate of interest per annum takes 3 months. What should be the rate of return to send a stock price from 100 rupees to 106 rupees in 3 hours? If you realize this, you will realize the utter futility of speculation. If you see the long-term return on the Indian stock market, the sensitive index, it has given you about little more than 16% compounded. 16% compounded. Even less than the 24% example I've given you here. That is why there's this beautiful old stock market saying, 90% of speculators lose, and the 10% who say they don't are liars. Jason Zweig, I told you, one of the finest writers on investment, he says, people who invest make money for themselves. People who speculate make money for their brokers. And that is why stockbrokers and other financial services types will always tell you, you cannot invest for the long term. Buy in the morning, sell in the evening. Buy today, sell tomorrow. We'll give you tips, we'll give you research, we'll give you SMSs telling you what are the things you have to buy today. We'll give you research reports, we'll send you emails. Today on smartphones, we'll send you all sorts of things. The whole industry is engaged in a game to make people trade more and more. Why? Because every time you trade, brokerage is generated. Very few people will tell you, don't trade, invest for the long term. Jason Zweig says, speculating becomes mortally dangerous the moment you begin to take it seriously. If you really think that you can make a living out of speculation, you have taken the first step on the path to bankruptcy. This is what happens to a number of people. And John Bogle tells us exactly what's happening at least in the equity industry today. He says, much of the investment industry is engaged in a hell-bent mission to take hold of the finest instrument ever created for long-term investing, which is equity, and transform it into a vehicle for intermediate-term and even short-term speculation. This is the game that is going on all the time. This is what happens when you get calls from brokers' offices to open this demat account, that trading account. One of the worst things you can ever do is sign the client and demat account opening form without reading it. Unfortunately, SEBI itself has put so many clauses in it that reading it gives you a headache on page number 1 and you have got page 20 to read. But at least one thing that you can do is read some of the headings and make sure that you never sign what is called a power of attorney. It will be there somewhere in between. If you sign that power of attorney, you are giving the broker authority to trade on your behalf. There is one more type of power of attorney that you can sign. That is, if you give an order to automatically transfer the shares from your demat account only for settlement purposes. That at least I can understand. That prevents you from always going and having to sign a delivery instruction slip. Be very careful of what you are signing. Otherwise, there are a lot of people who have opened accounts given a certain amount of money. Then all the money is lost. In a few cases, not only was the money lost, then they were told that they have to pay the broker something. And when you got the notices, that's when you sit up. But when they come to me, I tell them, look at what you have signed. You have given full authority. You have accepted that you know that the stock market is risky. You have willingly given your neck. There is nobody you can blame now.